Trevor, thank you. And this is exactly what happens if you hang out with wrong set of people, right? We're just hanging out, doing our thing. Trevor goes, loosen up a little bit. I was struggling. I was like, what do you mean by loosen up, right? Sanjay goes, here we go. That's my trophy right there. So that was a fun. That was a fun one though. Thank you, Trevor, for going out to helping us out, right? All right. So for us, one of the premise that we have is once the webinars, it is all about what we do, how we go about it, what we're seeing, so that all of the investors can learn, right? I'm proud to say, Massive Capital, it's the only team, syndicating team, owner operator as well, that last 2 years that we have been here. This is our third year, by the way. January 7th was our third year mark. Every week we came out for the last 2 years, and we are in front of everybody, sharing what we do, how we go about it. And you'll see some of this back end work that we did last quarter, and we're coming out. So just hang tight for a little bit. So the first thing that we did is that once the webinar, we moved that to Transformational Tuesday. So every Tuesday, we have something to offer. 2 Tuesdays of the month, we'll host our case study or transformational webinars. And the other 2 Tuesdays, we'll have the She webinars. And Maria, I was playing with it, the She webinar. I put the name Wondrous She, like, the Wonder Woman is like Wondrous She. It's kind of cool name. I kind of liked it. I was like, you might want to try it out a little bit and see what happens, right? All right. So on that note, let me get started. So one of the thing is the winning. It's interesting how world sees it, right? Last year, Sanjay went to Mount Kilimanjaro, and every time we do something cool, we take a selfie, post a picture, right? It takes a lot to get there, and he did it. He likes to climb mountains. He did Mount Everest base camp. He did Kilimanjaro. Now he has Machu Picchu on the line, and he'll do something crazy like that. He runs a lot. Usually, when you get a picture, we're like, "Whoa, this is pretty cool. He did it. Good job. Now I want to do it." Or someone might want to do it, but what really happens, how we see it. Sanjay is on the right-hand side. He has a whole slew of team that helped him to get out there. It took 11 team members to take two people, Sanjay and his friend on the right, two gentlemen on the right here, to take from the base camp to the top of the Kilimanjaro. And I believe this guy right here, last time when I heard from him, he did over 100 round trips from going up and down. So it takes a whole set of 11 people who are doing this day in, day out to take somebody and train somebody less than 9 days from a zero to Kilimanjaro. So let's remember, there's a setup behind someone to whatever that you see. So if we believe we can come out and invest and we'll be the best investors ever, there's a lot more that's going to go in. So it's going to be careful. So our goal is this part of this transformational Tuesdays is share on the back end of it. And we'll start today some of the reframing, some of the objectives, expansion of some of these topics that we talk about as we go forward. All right. As I always say, it took 11 team members to take one team member up on top. So it takes a lot of backing, a lot of homework as you kind of go. Okay. Let's look at the next one, as we call it. We do a lot of education, a lot of seminars where we go through the back of the S with the master class or Centurion Expo. That's the new name. Sorry about the typo. On the left-hand side, you'll see oftentimes you get an ad. Fund of funds are great. It's super easy. And oftentimes, if you're active investors, then if someone tells you, hey, I like you, I'll invest with you. Or if you're a capital raiser, if someone says, hey, create the content, put them on a Facebook, money will come in, right? So many ads that we see, it is so easy to call 5 people to raise $5 billion who's going to invest and make another $250 million, right? And also, oftentimes we're going to hear more, the building a team is easy, and you can do asset management, all this other good stuff. But oftentimes, we don't talk about it, that fund of funds are easy, but it has a cost associated with it. It is somebody's going to give us hard-earned money for 5 years, and we have to nurture that as you go through, right? If they like you, they will invest with you, but starts with the historical life work performance. We want to invest with someone who is performing. If they haven't performed in real estate, that's fine. Then you look at what they have done in the previous life. So the historical track record, the life track record has a big impact of how we do it, right? And just because we have a website doesn't mean that people will show up, right? It takes a lot of work, a lot of practice, a lot of mistakes will happen, then show up. And asset management, it's like a CEO of a company. We look at our team, we always say, look, it's a job for next 5 years. You may love the job, but it's a job till we have the asset to make sure that we protect investors' money. You know what to do, then you go about doing things, right? So all in all, we are walking the same path that you intend to walk if you're passive investors or active investors. We will share our journey with you so we can improve the quality of your journey. And that is the biggest thing that we can drive to our investors and our sponsors and our co-sponsors and our partners. It's about sharing the hacks, right? If you walk the path, hundreds of times, daily, monthly, weekly, whatever you call it, if we can give you a little shortcut, if we can nudge it over the right direction, if we say, hey, watch for this kind of things, it helps you out. All right, so today we kind of reframe what we do. We invest in commercial real estate, and the framework that we use, most of our things, it has three different ways to do the deals. It could be a LP or limited investor, it could be a GP or lead or co-sponsor, and it could be a JV or solo. Most of the conversation that we do is the framework of syndication. We also do JV, but it is the high ticket items as you kind of go through. But usually most of the conversation that happens here. So in other words, if you're commercial real estate, you want to come into commercial real estate, those are the avenues to come into the deal. You can come in as a limited investor. You can come in as a lead sponsor or a co-sponsor, or you can also come in on JV or solo. And our goal is to give you all the examples in front of you so you can, come in as simple. The easiest path that matches your background, right? We call it commercial world is competitive. It's extremely competitive. To win, you must have a competitive edge. Always remember what's your edge. If you're an LP investor, what is it that you have working on your side so you can identify better projects to invest? If you're a lead sponsor, what is it that you see in a deal that others are not seeing? Same for the JV. If you want to buy an asset, what is it that you have? Others aren't seeing it unless you'll be paying highest price possible, right? Okay. So let's get into 2025 plan a little bit. Again, this slide deck that we have is not a whole lot. I'll leave most of the Q&A session open so you can kind of have a two-way conversation. Would appreciate your feedback. I see the crowd is a little low today. Our texting, we moved from a Tuesday to Wednesday. It didn't go out all the text, so over time we'll see more people as they come in. That's Jasmine. She leads the she for us, and also she is one of investor relations. And as we go through, we always appreciate all of our team members as we go. She's not here today. All right. So the first thing, as an investor coming into the commercial real estate, you need to build your portfolio. And from the massive side, we believe de-risking the portfolio and adding more strategy in a portfolio. That's what we follow within our partner level. That's what we follow in our group level, and that's what we preach as well. That's what we practice. We don't believe that if I have one strategy, a very specific niche strategy for long term, that may not be sustainable, because if I were to buy one type of asset, one type of size, one type of strategy in one location, if one of them falls out, a bunch of things will fall out. So our ask is that look at your portfolio, start with that an investment hypothesis, and then look at the asset classes that you have. Once you design, once you design what you want to do, look at the asset type, look at the location. So you de-risk. We create the investment hypothesis that what is it they're looking for. When I started, I was looking for equity. So to me, cash flow didn't matter. All it mattered is how quickly I got my return plus more. Over time, we went into cash flow. My equity type, equity cycle time didn't matter. All it mattered is how much of a cash that I needed. The type of investment that I did for the equity multiple isn't the same time when I did for cash flow. And over time, I mixed and messed it up, right? So, and then I will always distribute. So Houston behaves differently than Dallas. Dallas will behave differently than Carolina, and Carolina will behave differently than Florida. So just because we have done, investment across the state line, my portfolio is diversified, and then understanding how they would behave, should be okay. I invested in Colorado, knowing Colorado behaves similar to Austin, which is if Dallas moves 12 inches, positive. Austin, Colorado will move, or Austin or Denver will move 18 inches, right? Because they kind of bounce. If it goes down 12, Austin and Denver will go down 18, and that's what is happening. So knowing we invested it, so if Austin price rent goes up and down, I'm okay because that was the hypothesis. So for you, you need to understand what your hypothesis is, and if that's a financial freedom, make sure that you understand assets, asset types, geolocations, and then most important, timing to exit. What I'm at. So if hypothetically you have $500,000, you want to draw 5 times, $100,000 each, 5 investments. If I start in 2025, all of them, and I select, I'm going to do value add multifamily, standard practice 5 years, then all the money that's going to come back to me, it's going to start at 2030, then plus minus 1 year. In between then, it's empty. So, or some cash flow is going to come in. But if I choose to say, you know what, I'm going to do one investment that comes back at 2030, one investment that comes back at 2028, then one investment that comes back at 2026, all of a sudden, your portfolio is moving. Your money in, money out. And so slowly you are building a small flow of money. So when the deal comes in or cash flow comes in, depending on when the market changes, you can optimize your portfolio as you go. So it's very important to understand the portfolio, where you have invested, how you have invested, what is the expectation of the investment, then you kind of go, right? So ultimately you'll have two options. Either you'll be actively passive or you'll be really active. We don't believe passive is completely passive, right? If you are a passive investor, some of you guys are, we know we are. It takes time to kind of go through. So next week we'll really talk about it, how, or in our next webinar we'll really talk about it. What does the passive mean? What does the active mean? More into it. But for now, you'll get into two buckets: actively passive or really active. So we'll talk about both as we kind of go through here, right? So let's see, all of us, we start with something. Have Excel file. If you need the Excel file, drop a note. We'll find a way to email that to you. So you'll have it at least to get started. So let's say you start a build, portfolio. You have a strategy. Then the question becomes, how do I understand where my market cycle is, right? We went through the down cycle, and we understand 2022 and 3, and we also understand 2024, right? We believe every market, it's a deal-making market. Every market you can buy assets, but not the way you bought it cycle before. Not the assets you bought it cycle before, right? Most of the deals that went south, that's mostly because, number one, it was highly levered and that was purchased in 2022, 21 to 22. In a high cycle, you don't lever, you stay unlevered as much as you can. And we did that for most of our portfolio, working out fine. The first one, we cut the tail end of it, but given the price point we came in, it's working through. It's gonna be a cash out refi in about 5 months, right? We're going. So understanding the cycle and then act on it, so it has enough breathing room as you kind of go through. Now, what it also means is that when the market is at its worst, which was last year, this year we're like last year, the cleansing happened phase 2. This was the phase 3, which is pushing the glut out of the system this year. So tunnel is this year. If you think about it, debt, interest rate has been resolved. We know where it's at. One of the biggest risks is out. The government change already happened. One of the biggest risks is out. Economic expectation is more or less set. We're gonna go after cost. Our economic condition gotta be healthy. To be healthy, you gotta lean up the fat. To do that, we're gonna go after some of the jobs. That's gonna happen Q2, Q1. We're gonna start. Q3 will end. Q4 will come back out. So in 24, end of the 25, we're gonna have a clean path. So whatever bubble that we had in 22, it bursted, residuals are being cleaned up, and then you go ride the tide as you go through. So what it means that if you're an investor, if you're an LP, or if you want to be getting into it, this is one of the best time to start prepping for it. So when we go through the process, you get to pick up the deals that makes much more sense. And you're on the other side, so all you have left, go side, then go up, not go down. If I can protect not going down by design, we'll make money on the other side of it. So understanding where we are in the cycle, designing the deal accordingly, and that is a very important place to start. And those kind of things will not happen unless you keep educating yourself, keep telling yourself as you go. Remember, news is, the definition of news, that when it doesn't happen that often. So when you hear news, it's a news. And then understanding the news, seeing through the noise, and then making a decision, that's what the investors would do, right? As an investor, our job is to manage risk. That's how you add value. That's how you create wealth. Understanding the risk, it starts with understanding where we at. Okay. So second thing is knowing your asset type, retail, office, industrial, multifamily, hospitality, special purposes. Most of the time you'll see, most of the webinar that you'll find, it's going to be hovering towards multifamily. Easier to get because you got the house, bunch of houses, multifamily. Concept is easy. I'm running one and a house versus I'm running 100. Everybody gets it because if I have one house, after 10, 20 houses, you have to manage. After 10 or 20, you can hire a management company, but they charge you 10%. Once you have over 50 or 60, it's a management play. So that's the standard cookie cutter play that you have seen. On the other side, retail, passive retail, different way, different risk, different way of going about designing it, but it works. Us within our massive capital team, we invested in retail on top of the multifamily. That worked for us. Office, we don't do it. It's tough. It's a big boy play, not for us. Industrial, it's another fantastic play. Different ways of underwriting, different risk profile. You don't have the synthetic value add as much as multifamily, but it cash flows. Hospitality is great. If you're a hotelier, you do a lot of hotels, that's another business that you can get into. Special purposes, you have RV parks, you have mobile home parks. One of the some of the cash flows in mobile home park is just crazy. Issue is you can't scale it like multifamily, but if you want to buy 2, 3, 4, 5, create your own asset, why not? One of the best cash flows we have seen. We have assisted living. If you're a medical professional or you work in the realm of it, you understand this is one of the best cash flow asset categories you can find, where you're taking the landlord business, which is the house, then you apply a Airbnb business for elderly people, and that has a natural barrier to entry, and they pay via the insurance, so your expectation and your cash flow is huge. It is operationally heavy, but one of the cash flow that you can is there. We also invest in those categories as well. So understanding that you have different options, understanding that you have different asset categories, it's pretty cool on top of the market cycle, on top of your investment hypothesis, right? Now, if you want to expand more, what does it more look like? So we understood the cycle. So first we started with our portfolio, what we want. We pick a side, passive or active. Then you understand market cycle. And then you understand the asset type. And then you get into the cities. So I'm giving you some back-end picture of massive capital, how we measure. So we have a fund. We have 2 funds. We are on the market right now with our debt fund. We had our first fund of fund completed, thanks to Mike, about a month ago. So when we look at a fund, we ask a question: what are the cities, how they behave, and how the city is not going to change? Give an example: Houston. We always follow the revenue. Revenue, which is at the very bottom, the businesses, how many businesses we have. Then we take a look how many technical companies you have. That means it has a natural barrier to entry. The STEM companies are huge. And then you ask the question how they're growing, right? So overall businesses, STEM companies, the growth of those businesses in 6 years, then you go way on the top. How many graduates were happening? How many technical graduates are happening? Just because I graduated doesn't mean that I want to get paid, right? If I graduated as an engineer, Versus if I graduated as a doctor, if I graduated with the engineer with the PhD, with the metallurgy or the scientist or subsurface engineering, different pay structure, different thing than I just graduated with. I love you guys, finance guys, but I'm just saying, and early on, it's not the same, right? So we understand that we look at the academics on the top, we look at the job growth, then in between we see, and also we believe smart money knows more than us. Smart money should be VCs and the funds. So if you look at the second category of funds and investments, we follow the VC fund because they are ahead of us. They're looking at the STEM and the job growth and type of job growth, and they're funding money into the city. So if I know what they do, we want to tag along with it. So understanding your city is cool. I mean, look, our money should not care where does it go, what location, what color of the brick, but it's all about the return. And to get a return, you want to side with the positive as much as you can. So you can reduce from the mistakes, right? So all things equal, if you have options to deploy money in different cities, which city will have a better likelihood of going up faster than the others? That's the whole philosophy. Second one in Austin. Let's look at the bottom. Austin is like a 1/6, 1/5 of Houston, but the job growth is half. The STEM companies as much as that. Their business growth is a lot more than that. Look at the funding, right? $1.7 billion versus $2 billion. Houston is a mature city, steady state. Austin is young coming. Young kids, they do great, but also they throw a fit, right? What happens? Market goes up, they go up faster. Market goes down, they go down a little faster, but they're going to come back out. It's a resilient city because they have a lot of tech grads that from one city that's coming up. And this is the third city for the STEM growth. So technical will always come out ahead. If you step back and look at the stock market, most of the tech, before it was oil and gas, now it's tech. Tech will win everything. That's going to drive the money. They're going to drive the new blood in the neighborhood, and they're going to bring in the rush of economic power, and that's going to go through. So we follow the revenue as you go. And I'm giving an example of Texas here. Then we have some more, but I'm just giving some example how you need to understand your city, not what I get. Right? There's some technical aspect to the city. I'll always say job growth doesn't matter. I'm sorry, population growth doesn't matter. What matters is that population growth of adult. Migration doesn't matter. Migration of what type of job profile will matter. So I'll give an example. Harris County got 2 million people. By definition, we have new kids showing up every single day. So Harris County will always grow, right? Because new families moving in every day, they're having babies. But if you really want to know the city's growth, you ask the question, population growth for adults, which is total population growth minus the newborn. They get an interesting profile, right? So that's why we always say, it's interesting, and what you see on the surface is really like a 2-3 layers down. You got to go deep into it and then analyze that. Then the Dallas Fort Worth, right? It's 3. Look at Houston and Dallas, right? 3 and 3, about 5,000, 8,000, 8,000, 2,500, right? They have a lot more tech grads, but we ahead of the life science, so we balance it out. Our VC funding is more than theirs, but their NIH funding is equal. They're a little bit ahead. Dallas is a new city, and they have a lot more migration down the way. By design, they have a higher education system. But look at the bottom side. 230 businesses, 10K STEM, second highest growth in the business. So you'll see that Dallas will grow differently than Houston. So everybody knows multifamily here. You know how competitive is DFW. That's the reason. And where is Houston at? That's the reason. So understanding the city, you can adjust the price. Breaks my heart to say it. A lot of people came from the Dallas in the last 2 years ago and said, oh, Houston is cheaper, I'm going to buy. We live in Houston. We bought hundreds of properties in Houston. We couldn't figure out why they would pay it. They bought it because it's cheaper. But we're thinking it's high cost. Cheap and cost, understanding the difference is very important. And those are some of the reasons that we take a look at it. And then you have Phoenix. And then you have, our other parts of it, right? So if you take a look, all those categories, so we have a whole pattern of how we look at the city. That's how we identify some of the markets, and that's how we do it. And those kind of things, refreshing, doesn't happen unless you are also actively working. right? So going back, you have a hypothesis, you figure out what asset types you want to get into, you figure out how you what cities you want to get into. Now you got to figure out how do you underwrite? Who do you know in a team? Or how many, if you're a passive investor, you got to know how many Trevors you know, how many Sharars you know, how many Mikes you know. So you have a deal coming in. You always got to be in research mode. And then you have to see that, are they really performing, right? Are they really doing deals? If someone never took it, I mean, if someone took it 12 months, didn't go to school, didn't take a test, all of a sudden you ask them to take a test, what's the likelihood about you knowing them, right? So always you want to hang out with the team that they're active on the market, not on the sideline. You can take a break, 6 months, 12 months is fine, but the team that goes silent for a long amount of time, they're not in the thick of it. Whoever is in the thick of it, you want to hang out with them. So what happens, even though, once you in the thick of it, you'll make less of a mistake, right? And versus the others as you go through. Then asset management and the investor relations. So as you see more team, our thought is, if you look at any team that have more than $50 million worth of assets, they should have a back office. $100 million is the must have. We all get sick, then get sideways. If they don't have enough people to look at the assets, it's a problem. So if you're an LP, remember research, are they active? Are they doing deals? Do they have back office? And also do they have front office? If they don't, ask a question, what happens if that person gets sick? If you're a sponsor, same way. You can do 1 deals, you cannot do 3 deals when you have a full-time job. You can do it differently, but not the way you may think about it. At the same time, you may not have to do a deal, so you can just buy 2 deals and you're okay with it, right? So, and the last one is the deal flow. So from the massive side, we underwrite quite a bit. So I did that snapshot 26 minutes ago, or almost 35 minutes ago. So we saw that coming. We underwrote over 1,000 deals last year. And then our Q1 is 54 deals already, but those are mostly repeat deals. So we're seeing a lot of repeat deals happening that's coming into here. And also those are the asset types that we took a look. We look at multifamily, we'll look at mobile home park, we'll look at RV park, we'll look at storage, we buy land, we do new development, we do flex space, we do mixed use, we do retail. We have and to grow a company to 300 million, to $500 million, you need to have access to all those things. So when we say that you need to de-risk your portfolio, that's the reason that we look at all those asset classes and de-risk. So when the time comes, we can do the right deal. We can create the right amount of value by parking the money, right? If a land shows up, it has a cash flow. But if our investment hypothesis is, hey, I'm going to park some money where I had a windfall and I want to park some money where I want to make sure that I protect the downside. Go buy land, sit on it 3 years, do nothing, come back, you'll be okay if you buy it right. If you say I'm looking for really good cash flow, like a really good cash flow today, and I don't want to buy no more than 3-4 assets, go get a mobile home park, right? Or invest in mobile home park, right? Either way. Same for the RV park. If you say, hey, I want to know how to underwrite the deal, underwrite the modeling, underwrite the debt and structure. I want to be an active partner. I want to buy 2 RVs. I live in Austin. I saw in Georgetown. I love it. Go get it. But for you, you need to be active and need to figure out which way to go, right? So having a little bit more expanded view is good. So we always say, look at geographical location and look at your asset type, have 2 or 3 options on you. It's great. We have a big team. We can look at everything. We have our education program. So we're looking at a lot. It doesn't mean that you have to take a look at a lot, but our thing is pick 1 or 2, pick 2, then you kind of go in it, go deep in it, and then you go. So let's say you have everything. You thought through everything. And now last thing, you got to have a deal team, right? So what we say, it takes about 3 to 5 years to cycle a commercial asset. You'll be able to buy it. You're able to put the money. You're able to get the debt and equity. You know, to get the investor relations, equity and debt, all this other stuff. You got to manage the asset. You got to exit. It's easy. It's complicated as much you make it, because you know what? You got to have a whole team for it. If Shirai said, I am going to manage my asset a little bit, and I'm going to specialize on the asset management, then I need all the other friends for me to back up for me to run for the next 5 years. If I'm an LP investor, I'm going to look at an asset and I'm going to invest with the deal team. I need to see everybody's in place, ideally for one team. And then we ask the question, can I invest with you, right? Or if I want to do, the equity investors, I have some fund I want to invest. I have a big, chunky amount, or I want to be a fund manager. Then it's here. I need to get all those other people who can source deals for me. So I can go deploy fund for my family or my friends who trust me, assuming I know how to look at a deal, assuming I'm looking at a deal all the time, right? So going back, if you roll them all up, you'll have two options: be actively passive, or you be really active.